There's a room in Washington, D.C. where 12 people meet 8 times a year to decide whether you can afford a house. They don't vote on it directly. They don't campaign for your approval. Most Americans couldn't name a single one of them. But when they raise their hand in that room, your mortgage rate moves. Your credit card interest jumps. The cost of borrowing money for anything from a car to a business loan shifts within hours. And here's the uncomfortable part. They're not even elected. So who are these people? And why did we hand them this much power over something as fundamental as the price of money itself? Let's start with what money actually costs. Right now, if you borrow $1, you pay back more than $1. That extra monta, interest is the price. And just like the price of oil or eggs or anything else, it moves up and down. But unlike oil or eggs, the price of money doesn't come from supply and demand in the normal sense. It comes from a decision. That decision is made by the Federal Open Market Committee. The FOMC, 12 voting members, 7 governors appointed by the President and confirmed by the Senate, plus 5 rotating regional Federal Reserve Bank presidents. They meet behind closed doors in a building on Constitution Avenue. No cameras, no live stream, just a conference table, some economic data, and a vote. Their tool is called the federal funds rate. It's the interest rate that banks charge each other for overnight loans. You'd think that wouldn't matter much to regular people. But it's the anchor. Every other interest rate in the economy, mortgages, car loans, corporate debt, credit cards, floats, relative to that number, when the FOMC raises it, everything gets more expensive. When they lower it, borrowing gets cheaper. In theory, this is how they control inflation. Too much money chasing too few goods. Raise rates. Make borrowing expensive. People spend less. Demand cools. Prices stabilize. Economy in a recession. Lower rates. Make borrowing cheap. People spend more. Demand reserves businesses higher. It's elegant. It's powerful. And it's completely undemocratic. The Federal Reserve was created in 1913 after a series of banking panics convinced Congress that America needed a central bank. But they didn't want it controlled by politicians who might print money to win elections. So they built something unusual. A quasi-public institution, technically part of the government, but designed to operate independently. The Fed's governors serve 14-year terms, longer than any president. They can't be fired for making unpopular decisions. This was intentional. The idea was that controlling money is too important to live to the whims of election cycles. You need people who can make hard choices without worrying about polls. People who can raise interest rates right before an election, if that's what the economy needs, even if it costs votes. And for a long time, this seemed wise. The Fed was boring, technocratic. It did its job quietly. Most people never thought about it. But then 2008 happened. When the financial system nearly collapsed, the Fed didn't just lower interest rates. It invented new tools, quantitative easing, emergency lending programs, trillions of dollars created with a keystroke. The Fed bought government bonds and mortgage-backed securities to pump money into the economy. It backstopped entire markets. And it did all of this without asking Congress for permission. It worked. The economy stabilized, but it also revealed something. The Fed wasn't just setting the price of money anymore. It was deciding which institutions survived and which didn't. It was propping up asset prices. It was making fiscal policy in everything but name. And people started asking, should 12 unelected people really have that much power? Here's where it gets strange. The FOMC doesn't actually control interest rates directly. What they do is set a target range for the federal funds rate, say between 5.25% and 5.5%. Then they use open market operations to nudge the actual rate toward that range. They buy or sell Government securities. They are just the interest rate they pay banks on reserves held at the Fed. It's indirect, it's technical. But it works. Except when it doesn't. In March 2020, the Fed cut rates to near zero and launched massive bond buying programs to stabilize markets during the pandemic. Money became essentially free. Corporations borrowed billions at record low rates. Home prices soared. Stock markets hit all-time highs. Everyone cheered. Then inflation started rising. Not slowly, fast. By 2022, inflation hit levels not seen since the 1980s. Suddenly, cheap money didn't seem so cheap anymore. It was too much money chasing too few goods, exactly the problem the Fed is supposed to prevent. So they reversed course. Hard. The FOMC raised rates 11 times in less than 2 years, the fastest tightening cycle in decades. Mortgage rates doubled. Credit card rates at 20%. Borrowing costs exploded. And millions of Americans who had bought homes or taken out loans when money was cheap suddenly found themselves locked into a world where money was expensive again. Not because of a market shift, because 12 people in a room decided it. But here's the math that nobody talks about. The Fed doesn't just influence your borrowing costs. It directly impacts the federal government's finances. The US government has roughly $36 trillion in debt. Much of that debt is financed through treasury bonds, which pay interest. And the interest rate on those bonds moves with the federal funds rate. When rates were near zero, the government's interest payments were manageable. But now, with rates above 5%, the cost of servicing that debt has exploded. In 2024, the US government spent over $1 trillion just on interest payments. That's more than the defense budget. More than Medicare. It's the fastest growing part of the federal budget. So here's the uncomfortable question. Is the Fed independent, or is it trapped? If they keep rates high to fight inflation, the government's debt burden becomes unsustainable. If they lower rates to ease that burden, inflation could resurge. They're stuck between two impossible choices, and every decision they make has winners and losers. Savers benefit from high rates, borrowers suffer. Asset owners benefit from low rates. Workers hoping to buy a house suffer. There's no neutral position. And yet we pretend this is purely technical. We pretend it's just data and models and expert judgment. But it's not. Every rate decision is a political choice disguised as economic management. Let's zoom out. Most countries have central banks. The European Central Bank, the Bank of Japan, the Bank of England, they all do versions of what the Fed does. They all claim independence. They all insist they are above politics. But look closer and the cracks show. In Japan, the central bank has kept interest rates near zero for over 2 decades. Why? Because the government is drowning in debt and can't afford higher rates. In Turkey, President Erdogan fired multiple central bank governors for raising rates, insisting that high interest rates cause inflation, the opposite of conventional economics. In Argentina, the central bank printed so much money to finance government spending that inflation hit triple digits. The lesson is clear. Central bank independence is only as strong as the political will to protect it. And when governments get desperate, that independence evaporates. The Fed has resisted political pressure better than most. But it's not immune. President Trump repeatedly attacked Fed Chair Jerome Powell on social media for not cutting rates fast enough. Other presidents have done the same, just more quietly. The pressure is always there. And here's the deeper issue. Even if the Fed makes perfect technical decisions, it's still deciding who wins and who loses in the economy. It's still making choices that shape inequality, wealth, distribution, and access to opportunity. Those aren't technical questions. They're moral ones. Should the people making those choices be accountable to voters? Or should they be insulated from politics entirely? There's no easy answer. The alternative is terrifying though. Imagine if Congress controlled interest rates. If every rate decision required a vote, if politicians could lower rates before an election to juice the economy, then deal with inflation later. If special interests could lobby for cheap money, we don't have to imagine it. We've seen it before. Central banks, governments routinely manipulated currency and credit for short-term political gain. The results were chaotic. Boom and bust cycles. Financial panics. Currency crises. The Fed was created precisely to avoid that, and for all its flaws, it succeeded. The dollar is still the world's reserve currency. US financial markets are still the deepest and most liquid on earth. Inflation until recently was mostly under control for 40 years. But that success came with a cost. We accepted that a small group of unelected experts would wield enormous power, and we trusted them not to abuse it. That trust is fraying. When the Fed bailed out Wall Street in 2008 but let ordinary homeowners lose their houses, people noticed. When it printed trillions during the pandemic and asset prices soared while wages stagnated, people noticed. When it raised rates so aggressively that recession fears spiked, people noticed. The Fed's actions aren't neutral. They benefit some groups more than others, and the people making those decisions aren't accountable to anyone except their own judgment. So what happens next? The Fed is facing a credibility crisis, not because it's incompetent. Most economists agree. Its technical analysis is solid, but because the gap between its stated mission and its real-world impact is becoming impossible to ignore. It says it's targeting 2% inflation. But inflation is shaped by global supply chains, geopolitics, and corporate pricing power forces the Fed can't control. It says it's politically neutral, but every decision it makes has political consequences. And the public is asking harder questions. Why should 12 people decide the price of money? Why not 10 or 20? Why these 12 and not others? Who chose them? What interests do they represent? The most radical critics want to abolish the Fed entirely. Return to some kind of hard money standard where the supply of dollars is fixed and governments can't manipulate it. But that comes with its own disasters: rigid deflation, financial instability, and no flexibility to respond to crises. The more moderate critics just want transparency, more accountability, more democratic input into decisions that shape millions of lives. But here's the paradox. The moment the Fed becomes fully transparent or fully democratic, it loses the very independence that makes it effective. Markets need to believe the Fed will do the hard thing, raise rates even when it's unpopular. If that belief erodes, so does the Fed's power. We've built a system where the price of money, the most fundamental price in the economy, is set by a committee, not by markets, not by voters, by a handful of appointed experts in a guarded room. And maybe that's the best we can do. Maybe controlling something as dangerous as monetary policy requires insulating it from politics. Maybe the alternative is worse. But it's worth admitting what we've traded away. We've traded democracy for stability. We've traded accountability for expertise. We've trusted that the people in that room will always act in the public interest, even when the public has no say in who they are or what they decide. That trust held for a long time. But every time the Fed intervenes to save markets, every time it raises rates and tips the economy toward recession, every time it makes a choice that enriches one group while hurting another, that trust gets a little thinner. And if it breaks, if people stop believing the Fed is above politics, stop believing it's acting in their interest, then the whole system unravels. Because the price of money isn't really set by 12 people in a room. It's set by our collective belief that those 12 people should have that power in the first place. And belief is a fragile thing.